All right, we are back again. Greetings to everyone, and I'm back here again. I think 3 days ago, my phone was smashed just when I was in the process of sending document one of my because the person needed a document urgently for an assignment. I'm just trying to send a document to the person, and someone took the phone from the person. Oh boy, as soon as so today is Friday, and I'm not back online. I would have covered like two topics already, but still, it's not too late. Don't worry. It will still be on track. The most funny aspect was that one of my mates called me and was like, boy, my sister phone around. So I'll say, Charlie, phone around to say YouTube the band and the YouTube videos the band. Say, see, I'm not even asking about our mental state. Phone that I bought this key less than 2 months and it has been taken away from me. You won't even ask me, say, Charlie, my mental state is the same. You're asking me about all right. So please kindly like this video and also subscribe to the channel if you see this content to be helpful. Yeah, what I've seen is that I've realized people will be watching the video before. You can watch this video and then like 30 minutes, 40 minutes, but just using 1 second to like the video will become a problem. That's not good. That's not really encouraging me. Yes, so kindly like this video and subscribe to the channel. Thank you very much. All right, so in this session, we'll be talking about taxation of investment income and withholding tax. Remember, in our previous session, we spoke about taxation of employment income. We are moving on to investment income. All right, so let's kickstart. This session actually will be, I think, one of the most easiest sessions so far. We just have to pay attention and then know the rates. Yeah. So by the end of this session, we should be able to explain what investment income is, identify payments requiring taxes to be withheld, discuss the effect of withholding taxes on the final tax position, then also outline the withholding tax rate on certain payments. So this session basically outlines investment income and also withholding tax. This is some reading links you can look at for yourself. All right, so let's begin with investment income. So investment income of a person, sorry, the income of a person from an investment for a year of assessment is the gains and profit of that person from conducting the investment for the year or part of the year. You have to take this into consideration. It's either for the year or part of the year, right? So as far as you've had some profit or some gains from an investment within the year or part of the year, then it must be subjected to tax. So this kind of investment that I'm talking about is you buying shares and you receiving dividend, right? So it can be investment, income from investments can include dividends, interest, annuity, natural resource payments, rent, and royalty. Then a gain from realization of an asset as calculated under part 4. So again, from so when you already have an asset and then you are selling it, in the process you've made what profit, which is let's say the asset, the amount you sold the asset is higher than the written down value, for example, then you've had a gain. So that particular amount, for example, will be subjected, the difference or the gain will be subjected to tax. And also an amount derived as a consideration for accepting a restriction on the company, on the capacity of the individual to conduct the investment. Also winning from lottery, as we know already, betting is going on for Muhammad King. So I don't know whether they will continue or they will stop. So it was 10%, right? So and then a gift also received by the person in respect of the investment. Let's say invested in a certain bank Then you have been like the outstanding investor for that particular bank, for example, in the case of a particular investment, and they gave you, let's say, a car, then you'll be taxed, right? With that one. Then any other amount required to be included under Section 9, Section 59, which is the taxation of shareholders, then Part 2 or Part 6, if the amount is derived from the investment. All right. So now, all right. So the following are excluded from the definition of income from investment, right? So the first is an amount specified in respect of an exemption under Section 7. So remember, Section 7 normally talks about exemption, right? Which can be revenue from cocoa farmers, especially indirect, and like that follows, or that's from the if the income or the revenue is from cocoa, and also the income from the president and the like, right? So those are the exemptions. And then a final withholding payment. So a payment that has already been taxed already, fully taxed already, or has been like has a final withholding substance, then that particular payment is not supposed to go taxed again. Then an amount that is included in calculating the income of the person for uh, from unemployed from an employment or a business. So if in case there was some kind of income that was attributed to, let's say, employment, and it has been calculated already, then it is not supposed to be so added to the investment income. We assume everything has been taken out already, unless in some case we'll talk about this very soon. So now let's talk about withholding tax. So the Income Tax Act 2015, Act 896 provides for the withholding of income tax at source from specified payments to residents and non-resident persons. So withholding tax under the Act 896 refers to an amount that an agent of the commissioner is required to withhold from a payment to a payee of a transaction that is under the law. So basically, what this is trying to say is that there are some particular agents that the GRA or that the Commissioner General has assigned them to withhold tax, like to take tax on their behalf. So, for example, let's take University of Ghana as an example, where it has a lot of employees. If all the employees are to do what? To always go to GRA to pay their taxes individually each and every year, right? It will be very difficult, and then also there'll be a whole lot of queues there. All right, so in place of this, GRA has set University of Ghana as a withholding tax agent to take taxes from its employees and then go and pay the taxes to the GRA or to the Commissioner General on the employees' behalf, so on the lecturers' behalf, right? And others. So if in case Legon transact business with someone and the business is subjected to tax, Legon is going to take the tax and then go and pay it to GRA on your behalf. So this means that the law requires a person effecting payment to another person to deduct the exact tax at source and pay it to the Commissioner General. So the agent must also have to submit a return on all details concerning the payment. So that is basically it. I've explained this, and let's move on. We have types of withholding taxes. We have the final one, and then we also have payments and accounts. So with the final one, once any payment is made, once the final withholding tax is being deducted from a particular income, it is no more subjected to tax again. You get it? So now, let me use this. Let me try and illustrate this here. So let's say I'm a worker, right? And then let's say I'm a worker. Let's say I supply goods, right? I supply goods and then I supplied, let's say, good worth 3,000 Ghana cedis to, let's say, University of Ghana, right? So let's say the tax rate is like 5%. So we calculate 250 and then they will give me the 1% will give me 287, so 2850. Right? So this is the amount they are going to pay. And then this is a final amount. And this will not be included in any other income that will need to be assessed for tax purposes. Right? So if in case my annual income is like 10,000 cedis, right? This money won't come here again. They've already taken tax out of it. So if they are going to tax me, then they are going to only tax me on this 10,000, right? If this 2,850, sorry, if this 3,000 is not included, but if in case this 3,000 is included to make this 10,000, then they are going to take it out. So let's see, they are going to take the 3,000 out, and then to be left with 7,000. Then that 7,000 will be subjected to tax. Let's say the tax is 10%, then 700, then 6,000, so 6,000. So this would be what? My final amount. Right? But if in case it wasn't included, then you won't include it. But if in case it is included, then you take it out because it has what? A final tax. But let's now talk about the payment on account, right? The withholding tax that but it's payment on account. So same example as let's say for the payment on account, um let's say what again? Let's say I constructed a building, right? Let's say I constructed a building for University of Ghana. Then they paid me let's say 8,000, right? And let's say the tax is still 5% for this. So that's going to be 400. Then I'm going to get 7,000, right? So payment on account. So with this one, because it's payment on account, still this 8,000 will be included in my withholding, in my like accessible income for that particular. So let me use the same thing, that 10,000 here, right? And then now I'm now getting 8,000 in addition. Okay, I'm getting 8,000 in addition, right? But since the 3,000, which was having the final withholding tax was included here, I take that one out because they have already taken the final tax on it. So I take that one out. Then I'm getting 15,000, right? So even though the 8,000 has suffered a tax here, but since it is what payment on account, it will still be added on to your accessible income for that particular year. Now, if let's say you are being taxed of let's say if you are being taxed 10%, then you are paying 1,500 a year, right? Now, you will be relieved based on the first, this in the payments on account that you calculated, right? So that payment on account, this will be subtracted from this tax, right? So for example, you have 1,500 here, right? So you can what? Subtract, sorry, you are going to subtract the 400 here, right? So your tax is now going to be 1,000 here. Then you are going to have to take home money of 14,000, 13,700 or so. I hope you are getting the point, right? So for final withholding tax, they will not be added or be included in the accessible income again. But if in case it was included in accessible income, you take it even out. But if it wasn't, you won't include it. But for the payment on account, if it wasn't part, then you add it to the accessible income. But if it is part two, you leave it inside like that. And then once you calculate the full tax, you are going to take the payment on account withholding tax that was there already. You take it out of what you've calculated as the tax on the total accessible income. Right, then now you get your take home money. So that is it. That this is just basically the difference between the payment on account and then final withholding tax, right? I guess this is easy and straightforward. In case you have any more further questions, you can drop it in the comment section. Then we do what? We dissect and then bisect and then digest and then digest. So, um, all right. So that's basically it up to this point. Let's move on. Hope you get it. So these are basically what is here. That's what I've explained you there. Yes, and so basically the final withholding tax won't be included again. That particular income will be included in the accessible income again. But for payments on account, it will be included. But that particular tax, for example, will be taken out or will more or less like be something like a relief, something like that. So where withholding taxes are applicable as well as value added, okay. So where withholding taxes are applicable as well as value added tax, the withholding tax should be imposed on the gross amount of payments, but the gross amount of payment should be exclusive of value added tax payable on any goods, work, or service. So what this is trying to say is that where there is what value added tax and you want to charge withholding tax, right? First of all, take the value added tax from it and then now charge your withholding tax. So let's see an example here. So this is an example here, right? So the cost of work liable for withholding tax is 11,250, which is VAT inclusive. Determine withholding tax, assuming that the VAT rate is what? 12.5%, right? So if you want to determine the withholding tax, you can just bring it and then get your what? Your gross amount. So basically, you can do something like this. I'll show you two ways. So you can be 100 over 112.5 times 11250. You are going to get 10,000, right? You can do it this way, or you can just find 12.5% of the 11,250. Then you subtract it from the 11,250. You are still going to arrive at this 10,000. Okay, like that. So now that you've gotten the amount or accessible income, which is part free, then now you apply the withholding tax. So in this particular question, they use 5% as the withholding tax. So you can also use the same 5% here. So 5% times 10,000, which is going to be 500. Right. So this is going to be your what? Your withholding tax, 500. First of all, you take the VAT out. So let me go on with the other technique. So first of all, you have 11250. Then your VAT is 12.5%. So 12.5% on 11250, you are going to get 1250. Right. So when you subtract from it, you're going to get 10,000. Right. So now you apply your withholding tax on the 10,000, which might be 5%. Then you get your what? 500. This is so simple, easy, and straightforward, right? All right. So this is what it is here. All right. So withholding tax is for investment income. So this is basically some of the investment incomes and then their taxes. So when you receive dividend, you are supposed to pay what 8% withholding tax on it. And also it is final, meaning say the income wouldn't be included in your accessible income again. And the natural resource payments and royalties too will have final withholding tax of 15% on both resident and non-resident. Then lottery winning also have 5%. Now I think it has been changed to let's say 10% or so, which is also both, and it's what on final. Final means that it wouldn't be what's added to the accessible income again. Then we have service fees or insurance premium, 20% for only non-resident, and it's also what's final. Then subcontractor for a petroleum operation is also 15% for non-residents and also what's final. Then supply of goods and services is also 20% for non-residents and it's what's final. Then transport and communication is also 15% for residents and then what it's on account. So meaning that their particular income will still be what added to the accessible income for that particular year. Then fees to a part-time teacher, lecturer, examination invigilator, or examination supervisor, 10%, and it's for residents, and it has what the final tax, the final withholding tax. We also have interest payments, also to excluding payments made by individuals and payments made to residents, financial institutions. Also attracts 8% for residents, people, and then also what's on account. We also have rent, also 8% residents, and it's what's final. We also have rent of non-resident. Okay, it is rent of residential property, rent of non-residential. So rent of residential is like somewhere you can sleep for a while. And non-residential is somewhere you want to use to transact business. So that place is more or less like 15% and resident, and then it's what also final. Then fees, allowance to resident, director, manager, or board member trustee. So that one is also 20% resident and it's also what on account. So meaning that the income from that side will still be added to the accessible income and then assessed. We also have commissions to lotto receivers, 10% resident, and it's also what on account. Commissions to a sales agent, resident, insurance sales or canvassing agent is also what 10%, resident and is also what on account. Supply of goods exceeding, keep this in mind, exceeding 2,000 Ghana cedis per annum. 2,000 exceeding it will attract for 3%, and then also on resident and also on account. For resident and also on account. Supply of works exceeding 2,000, also 5% on resident and is also on account. Supply of services exceeding 2,000, 7.5 resident and is also on account. What I've stated so far is that all the non-residents are never on account. I've not seen any non-resident on account so far. All the non-residents are final. So anywhere you find non-residents, know that it has final. So last year, this thing came in exams, right? They'll just give the item. You are going to tell them the rate and whether it's also on account or not on account, right? So once they want to give me a tip about residents, I will know say it is on account or not on account or final. Yeah. The payment to petroleum subcontractor, for example, 15% for residents and it's also what's final. Payment for unprocessed precious minerals, 3% resident and then also on account. Then we also have management and technical services, which is 20%, non-resident and it's also what final. Then interest income is also 8%, non-resident and final. And short-term insurance, 5%, non-resident and also what final. So period of payment. So according to the Commissioner General, the withholding agent, for example, I use Eugene as an example. Eugene being a withholding agent is supposed to pay the taxes that he has collected from his employees at or within the 15 days after every month end. So for example, if this January ends, for example, the Commissioner General will give University of Ghana up to 15 February to what? Pay the withholding taxes collected. So the same thing, if it is so the 15th day of each and every month. But if you fail to pay, then you are going to be personally liable for that particular amount that you fail to pay. And if it continues, there might be punishment, there might be some penalties and the like. Then accounting for withholding taxes is more or less like a normal double entry, where you are going to what? Debit the receiver and then also what? Credit the giver, like the same steps now. Yes. So I think we've done a lot today. We explained what investment income is, and then we said it is what the gains and profits from investment for a year or part of a year. Then we went on to talk about some of the investment that we are talking about being dividend, income from investment, being dividend, realization on or gains from realizing an asset and the like. Right. We also discussed and identified payments requiring taxes to be withheld. And also we discussed the effects of withholding taxes on final tax position. And we also outlined the withholding tax rates on certain payments. That's what we did on the table. Then we discussed the offenses and penalties for failure to withhold taxes. Right. So thank you very much for your time. This sports our session for today. All right, 12 a.m. I'm signing out. See you tomorrow. Bye. Have a good night.